Welcome to Wealthion. I'm Wealthion founder Adam Taggart here with a special presentation for you. At Wealthion's online conference last month, investment manager and former Federal Reserve senior economist Lacy Hunt kicked off the event with his outlook for what to expect in 2022. And despite inflation's ubiquity in today's headlines, with a graduate-level parade of data and charts, Lacy made a very strong case that the forces of deflation are still very much alive and well and will soon once again prevail as the dominant macroeconomic trend. Now note, that doesn't mean he predicts your grocery or energy bills are going to come down anytime soon, though the rates of increase should hopefully slow. That may be small comfort though, should economic growth indeed become more and more sluggish and recessions become more frequent, longer, and deeper, as Lacy expects. And many of the conference goers who watched Lacy's presentation have been urging us to share it with the general public, given its importance, especially as so many investors are now on the side of team inflation. Lacy has kindly also given his permission as well. So let's jump right in and hear straight from the man himself. All right, looks like we're good to go here with the charts, Lacy. Why don't you take it away?
Thank you very much, Adam. I appreciate you inviting me back. It's a pleasure to be with you a year ago. And thanks a lot. Let's talk conceptually, structurally for just a moment. We have two basic problems that present major obstacles to a return to normalcy that have both worsened as a result of the last 2 years. When the pandemic hit, we were in a massive debt overhang, and the debt overhang is even worse today. And consequently, so are the deleterious effects on economic growth. And the second conceptual problem is that the monetary authorities introduced a program of revolutionary design. And there's a major risk when they do that, when they adopt something that's never been done before, because they don't know whether, in fact, they can unwind it. And in fact, the historical record has been a dismal failure. The father of modern psychology, Robert K. Merton, whose son was also Robert Merton, Nobel laureate, came up with the fallacy of the theory of programs of grand design. And he made the analogy of someone who sees a cave on the side of a wall, or side of a mountain, and it appears open. And so the climber goes in the cave and it's clear, and he moves into the cave and it's still clear, and he keeps moving in. And what he doesn't realize as he's progressing is that his movement into the cave has caused a cave slide. And it's not going to be possible for him to retrace his steps. And Merton's implications from the sociological standpoint has been confirmed by very serious students of economics. Economics is a science, it's a social science. We're not a physical science, but we've had very critical thinkers look at monetary and fiscal policy. And what they found is that when policy swings massively in one direction, that the policymakers don't have the capabilities to return to normalcy. And that's why such outstanding people as the Nobel laureate Milton Friedman, now deceased, John Taylor of Stanford University, John Cochran of the University of also Stanford, formerly University of Chicago, and the late Carl Brunner and Alan Meltzer have advocated that fiscal and monetary policy need to have constraints, that they shouldn't have unbridled discretion because of this path of trying to restore normalcy. And in the process of trying to do so, they damage the economy. They don't have those tools. And so with those two problems, let's get into them now, starting on page number 1. The blue line is the trend rate of growth in the economy from 1870 until we became very heavily over indebted in the late 1990s. It's running at 2.2% per annum. The black line is what we've achieved since then. And you'll notice that we're falling further and further below the trend line. If you go into the upper left-hand corner, at the end of 2019, before the pandemic hit, we were roughly $10,000 of real per capita GDP below trend. And now, after borrowing $5.5 trillion at the federal level alone, the gap is 25% greater. In other words, the evidence indicates that as we become more indebtedness, the deleterious impact is not steady, it's increasing. In other words, we're dealing with a nonlinear relationship. Let's move to page number 2. One of the aspects of the fact that we're so far below trend is that we've not restored the employment levels to where they were. One series, 2.9 million below the pre-pandemic levels, the other 3.5 million below. Let's go to the next page. Last year was a very unique year based upon looking at the real treasury yields. Now, we have this data since 1870. Over long periods of time, you can assume that the actual inflation rate is expected. Otherwise, investors will lose money. And using this set of data, last year, the negative long treasury rate was 2.3%. And excluding the war years, which is important to do for reasons that will become clear, there were only 12 such of those examples. But 2021 was a highly unique example, and it has really highly negative implications for where the U.S. economy is and where it's going. And we can see this by moving to the next chart. I've listed in all of the years in which the real yield was negative. And in the second column there, we indicate whether the economy is in expansion and recession. And in all cases, with the exception of 2, we're in recessions. One of those years was 1934. Technically, the economy was expanded, but it was in the middle of the Great Depression. The unemployment rate was 20%. So technically, we were in expansion, but conditions were unusually dire. There was only one other instance when we were actually in an expansion and the real yield was negative. That was 1979. But what is unique about 2021 are the total debt to GDP for the 1 year, the 5 year, and the government for the 1 year and 5 year. The 1 year debt total was massive, 393%. The 5 year moving average, which is a critical metric, as I'll discuss, was 378%. Makes a great deal of difference whether you have a short-term rise in debt, cyclical, so to speak, or whether the debt is sustained for a long period of time. The government debt ratio last year was just under 130%, may substantially higher this year. And the critical metric is the 5 year moving average, which was almost 115%. And as we're going to see, bad things really happen once you start hitting 60, 70, 80, 90, and then above 90%. So to the simplistic model, the so-called ceteris paribus model, you look at the 2.3%, you might think that that is a plus for economic activity. In other words, real yields are lower. It should stimulate economic activity. But the world is not characterized by ceteris paribus. It's characterized by mutatis mutandis. All things are moving at the same time. And when you're highly indebted, and you've been highly indebted, and the real yield is negative, What it means is that investors are not going to be able to price through the risk premium on their debt capital, and they do not have incentive to invest in physical aspects of the economy. And without physical investment, you cannot get growth. And this will impair such things as velocity and even such important considerations as demographics. Let's go to the next page. Page number 5 is very important because it's a highly prescient publication that came out almost 10 years ago. In fact, more than 10 years ago. It appeared in a peer-reviewed publication of the American Economic Association. The authors are Carmen Reinhart, Vincent Reinhart, and Ken Rogoff. This is not the 2008 paper where there was a transposition in an Excel spreadsheet. These numbers are perfectly solid. And let's look at their findings, because they are so important, keeping in mind that they were developed more than 10 years ago. The first finding on line number 1 is designated is that the economic growth rate is reduced by slightly more than a third against trend. Well, right now, line number 2, since 2000, we're falling 2% below trend. In other words, as we become more and more indebtedness, the degree of negative impact is increasing. And that's important because it indicates that there's a nonlinear relationship at work. And there are other scholarly studies that confirm that. So you need to be asking yourself, what in economics is nonlinear? And the nonlinear relationship that explains it is the law of diminishing returns. When you take on excessive indebtedness, initially you can boost GDP, but if you continue taking on more indebtedness, the impact on GDP becomes neutral, and then further increases in debt, you get declining economic activity. In other words, there's a zone when debt is helpful, when it's immaterial, and then when it's negative. And we are taking it further and further into the negative zone. Point number 3 is highly important. This research, this decade-old research, has clearly met the test of time, and it has been confirmed by other scholarly research that I'll get to shortly. And point number 4 is that the debt overhangs were related in this 2012 paper to real interest rates. And I want to read what the authors wrote. Contrary to popular perception, we find that in 11 of the 16 debt overhang cases, real interest rates were either lower or about the same as during the lower debt GDP years. Thus, those waiting for financial markets to send the warning signal through higher real interest rates that real governmental policy will be detrimental to economic performance may be waiting a long time. That's exactly what we're seeing today. Let's go to the next page. The evidence that we see in the United States is, of course, confirmed globally. We're not as indebted as Europe. Our marginal revenue product of debt has dropped from 2000 from 30 cents to 25 cents, but in Europe and Japan, it's only 20 and 15%. The Japanese prime minister just announced that they've been overstating their GDP figures for years, which means that the marginal revenue product of debt in Japan is even lower than indicated on this chart. And that's important because we can see that Europe and Japan, more heavily indebted than the US, are falling behind us. Let's look at the next chart. In 1995, the first time we have comparable data, Japan was actually wealthier in the United States. Our per capita real GDP, measured in 2010 dollars, was 7% lower than in Japan. Now we're 13% greater. In 1995, we were 23% larger than Europe, and we're now 38% larger. In other words, we can see that the debt is having a deleterious effect in the US, But in Europe and Japan, which are more heavily indebted than we are, the negative consequences are even more extreme. Let's go to the next page. On this page, you're looking at the marginal revenue product of debt for total domestic non-financial debt. That's the top line. It's available since 1994. Total debt is available since 1870. First of all, notice the shape of both of those curves. They're basically parabolic. It's not smooth because it's economics. In other words, there's a rising phase, flat phase, and falling phase. That's confirmation of the law of diminishing returns. Let's look at the next page. So looking at line number 1 in our base period for total debt, every dollar of new debt was adding 62 cents of GDP. We're down to 25 cents. For financial debt, line number 2 in the base period, we were adding 68 cents of GDP. We're now down to 35 cents. And there's Europe and Japan, significantly lower than we are. Let's look at the next page. There are 17 different scholarly studies which document the deleterious effects on debt post 2009. And I picked 2009 because that excludes the very first paper by Reinhardt and Rogoff that with certain really immaterial questions were raised. These by different scholars from all over the world. And they're listed on page 10 and page 11. And let's go to page 12, and I'm going to summarize 3 of the most important findings. Let's look at paragraph number 1. This is from a peer-reviewed publication of the American Economic Association to Swedish economists Berg and Hendrickson, both Harvard educated. They find that there is a significant negative correlation between the size of government and economic growth, that every percentage point increase in government, every 10 percentage point increase in government is reducing private GDP by 0.5 to 1. And the important finding is that this means the government expenditure multiplier will become more negative. There is no government multiplier, regardless of what you may have learned in your economics course. It's been negative since the early 2000s, and it's becoming more negative. We have additional confirmation from study number 4, done by economists at the London School of Economics, the Wharton School, and the University of Maryland. They find that when government debt rises above 60%, you begin to see this negative effect. And it's a condition that is met in most major countries today, and it means that the government spending multiplier is highly negative in these indebted economies. Let's go to page number 13. I want to draw your attention to study number 8. The 2 writers, Dr. Christina Checharita, she's now Checharita Westphal. She's Director of Fiscal Affairs of the European Central Bank. Dr. Philip Rother is Chief Economist of the European Economic Commission. And I want to focus in on 2 things. They find that when government debt begins to rise to higher levels, that there is a non-linear impact. In other words, at 50 or 60% debt to GDP rate, the effect is minor. You go up, the effect becomes more deleterious. And in their models, the effects are particularly great above 70 to 80%. Let's move to the next page. I now want to turn to monetary policy. Monetary policy is widely misunderstood because the Fed does not control, the money supply is not controlled by the Federal Reserve. It is what we in economics call an endogenous variable. The formula at work is at the top of the page. It says M2 equals the monetary base times the money multiplier. The Fed, the monetary base is the Fed's balance sheet. They do control that. Up until just very recently, the Federal Reserve has tended to promulgate the view that the money multiplier is stable. In other words, if you have a 10% reserve requirement, you apply the binomial theorem. That means A 10% reserve requirement gives you a $10 increase in money for every dollar in reserve. That model was never valid. Notice the multiplier has not been stable. In the Fed's literature and in the textbook, they say if you eliminate reserve requirements, the multiplier should rise very radically. They eliminated reserve requirements last March of 20. There was a slight increase in the money multiplier, but it's declining. The reason the Fed does not control the multiplier is that the banks have to push through all of their cost when they lend out reserves. They have to price through the cost of money, the cost of overhead, and they have to price through the risk premium. In highly indebted economies, the evidence is overwhelmingly that the banks cannot price through the risk premium, and the multiplier falls. So now what's happening is the rate of growth is slowing. The Fed was buying at 120 billion annual rate. They're basically buying at a 60 billion rate now. By the end of March, they will be buying at a zero rate, and they possibly could allow the balance sheet to roll off once we get into the spring quarter. So the monetary base growth is coming down, the multiplier is declining, which means that money supply growth is going to slow abruptly. Let's go to the next chart. Money supply has already slowed from a 20% rate of growth down to 10. Given the Fed's tapering and the decline in the multiplier, by the end of the first quarter, M2 will be under 4%, perhaps negative in the early part of the third quarter, which is below the long-term trend, which comes in there, the dashed line, around 7%. Let's go to the next page. But we also have to take into account the velocity of money. Look at the equation at the top of the page. Money times velocity equals GDP. Velocity, like the money multiplier, is endogenous. Notice that velocity peaked at $2.20 in 1997, has been coming down. That's also a parabolic function. What you'd expect, a nonlinear relationship. When you start taking on debt, initially the marginal revenue product rises, flattens out, and then declines, indicative of a nonlinear relationship. Let's go to the next chart. This, in our opinion, explains what determines velocity. The red line is velocity indexed to 1 in 1952. The blue line is a weighted average of the marginal revenue product of debt and the commercial bank loan to deposit ratio. First of all, notice the basic outlines of the parabola: rising phase, flat phase, declining phase. Given the fact that we're becoming increasingly more over-indebted with unproductive debt and declining marginal productivity, velocity of money will continue declining. Let's go to the next chart. Money supply growth has slowed around the world, and given the fact that the U.S. is the world's reserve currency, as U.S. money supply growth goes to 5 and below 5, we will start pulling money supply growth down around the world, reinforcing the constraint of monetary policy exerted by the Reserve Bank of the world. Let's go to the next chart. Velocity is declining in the United States. It's dropped from 220 to 110, but in Europe, money turns over less than 1 time per year. We're at 0.84. Notice that the official figures in Japan are hovering around a half, but forensic studies have indicated the Chinese data is overstated. And now we have confirmation from the Japanese prime minister that their GDP is overstated, which means that velocity is even weaker in Europe and Japan. When velocity declines, it basically makes monetary policy asymmetric. If the Fed or a central bank wants to tighten, that will work, but if they try to ease, monetary policy is largely ineffectual. It becomes ineffectual because of the over-indebtedness situation. Let's move to page number 20. I want to share a couple of pieces of new research, very brilliant research in my opinion. This research was conducted by Xavier Gabay. He is professor of economics, finance at Harvard, Ralph Kogen of the University of Chicago. And what they did was estimate the price elasticity of demand for stocks. Now, I want to draw your attention to the third line. Price elasticity of demand is one of the basic concepts in economics. We call price elasticity epsilon. It's the percentage change in quantity demanded divided by the percentage change in price. I left off percentage change in price, but it should be there. Gabay and Kojin found that the price elasticity of stocks is only 0.2, which means that it is highly inelastic. In other words, for most investors, they consider stocks to not have good substitutes. But when something has high price inelasticity, a small increase in demand or decrease in demand has a largely disproportionate impact on price. So let's look at the formula and rearrange the formula and make the calculation and assume that demand changes by $1. So it's the percentage change in price is 1 divided by 0.2, which means the change in price is 5. In other words, when demand is flowing into the market, price goes up $5. But if demand is flowing out of the market, price declines by $5. But here's the critical point. The Fed is now tapering. When the Fed provides liquidity and the multiplier falls and the velocity of money falls, the liquidity goes into the financial markets primarily. But when the Fed reverses that process, it begins to drain liquidity from the financial markets primarily, to some extent from the real economy, which means that the very act of the tapering removes a very important element in the demand picture and what has previously been the upside volatility of stocks. Let's go to page number 21. This is very important research from the Fed of New York. The critical article, the two critical authors, Gianpaolo and Paolo. Gianpaolo is the head of research, the senior vice president of research and statistics at the New York Fed. And I'd like to just, and Paolo is the vice president and deputy research of the Fed at the New York. Let's go to the bottom of the first paragraph. And I'm going to just read some of their findings because this is critical. It's a break with what's in the standard economics text. It's a break with what the Federal Reserve has previously expanded in the literature that they pass out to the public. These findings indicate that money is endogenous and the central bank does not either control the supply or demand considerations. On the supply side, they point out that the banks have to price through the risk premium and that they are not able to do so in the current environment. So let's look at their exact statement with regard to demand and supply. On the demand side, they write, in an environment of low interest rates, the private sector, quote, may be unwilling to take advantage of the greater availability of liquidity to finance consumption or investment spending. Consequently, money velocity falls and money multipliers shrink. Central bank liabilities increase considerably, but nominal spending does not. And their conclusion, looking at both supply and demand, they conclude the international experience does not suggest that quantitative easing is necessarily inflationary. Well, if the injection of reserves into the banking system did not create the inflation that we've all witnessed this year, what did? Let's go to the next page. This is your basic general equilibrium model from macroeconomics. On the horizontal axis, we have the level of real GDP. On the vertical axis, we have the aggregate price level. The AS line is the aggregate supply line. It's upward sloping. Producers will produce more at higher prices. So what happens when there are supply side disruptions? The entire aggregate supply curve shifts upward and toward the left. In other words, it shifts to AS sub 0, which means the equilibrium point moves from point A to point B. Thus, there is an increase in the aggregate price level from P0 to P1 and a decline in real GDP. But keep in mind that the output gap, the difference between potential and GDP, increases. In other words, the rise in prices destroys demand. Now, why is this not like the 1970s when the Fed was increasing the money supply and we were getting substantially higher inflation? Let's use the same aggregate demand and supply model going forward. Let's go to the next page. So we start with the shift in the aggregate supply, the supply side disruptions. In the 1970s, the Fed shifted the aggregate demand curve upward. And this, therefore, allowed the price level to rise even further, from piece of one to piece of two. But look at the definition of the aggregate demand curve. Aggregate demand equals GDP, but by algebraic substitution, it also equals money times velocity. In the 1970s, the velocity of money was stable. Thus, as the Federal Reserve was accelerating monetary growth, it shifted the aggregate demand outward. And this resulted in the confirmation of a record decadal decline in the dollar. Now, if you look at the trade-weighted dollars, you probably won't see that because there were two distinct devaluations of the dollar during the 1970s. One occurred in 1871 when Nixon closed the gold window, and then there was an ongoing market-based decline under Federal Reserve Chairmans Burns and Miller. What is happening this year is that the increase in money is being thwarted by the decline in velocity, and the dollar is stable to slightly higher. When the dollar declined in the 1970s, this created an umbrella effect, allowing producers to raise prices and thus allowing the domestic producers to increase under the umbrella. Entirely different circumstance. So, in conclusion, I would like to add one other element that is in the economic picture that I have discussed in the past in numerous situations, but is really quite critical to assessing how the U.S. and the other economies of the world are going to do. And that is that demographics are continuing to deteriorate. We don't have the final numbers for the rest of the world for 2021, but we do for the United States. Last year, our population increased by just 0.1%. This was the smallest increase since the founding of the Republic in the 1800s, in the 18th century. There were a couple of noticeable firsts. The natural increase in population last year was less than the immigration. And second, the total net increase in the population was less than 1 million for the first time since 1937. Now, COVID explains the jump in the death rate, but we had another precipitous decline in the birth rate, which is contrary to what many demographers predicted. They thought that bringing people to close proximity would lead to an increasing birth rate, but it did not. The early evidence is that the demographics are deteriorating even faster outside the United States. Now, why is demographics a problem? Well, because it retards investment, household investment, business, state and local investment. Families are expensive, not only for the families that raise them and birth them and train them, but send them to college, but the business that supply to them and the state and local governments. It comes through the investment account. And so when you have less demographics, it actually feeds into the deleterious effects of the debt of the debt. The debt brings down the standard of living growth, which contributes to weaker demographics, and then the weaker demographics contributes to the deterioration in the economics growth. I want to quote my friend William Stull, professor of economics, who likes to make the case that for nations, demographics is destiny. And he does that because of the importance of highlighting this critical variable for the secular growth in determining economic activity. So in actuality, we have three challenges to a restoration of normal. We have a considerably worse debt overhang. We have the perilous task of trying to restore the economy to normalcy from a theory of grand design for which we never tested. And third, we have this continuing onward deterioration of demographics. Adam, that concludes my remarks.
Don't click away just yet, folks. If you enjoyed this excellent presentation, you definitely don't want to miss the 25 minutes of audience Q&A we recorded with Lacy right after his presentation aired at our conference. To watch that right now for free, just go to wealthion.com/hunt. But before you do, help support this channel in bringing you more top-notch financial content like this by hitting the like button and clicking on the subscribe button below, as well as the little bell icon right next to it. Okay, now you can go to wealthion.com/hunt to hear the Q&A with Lacy. Thanks for watching.